Good morning. Welcome to my very first video. My name is Felix and I am a financial advisor based in Adelaide, South Australia. Today, I would like to talk to you about how superannuation works. Many of you may be just like me in the past. I recently graduated from university or high school. This is back in 2003. And I had my very first job. At that time, my employer asked me if I have any superannuation. And I go, what is that? I don't know any superannuation. What is superannuation? In the simplest form, my employer at that time said to me that superannuation is basically his obligation to give me 10% at a time. No, sorry, 9.5% of superannuation on top of my salary. And this money will go towards my retirement fund. I was young at that time. I don't even know about retirement. I didn't think about retirement at all. So I guess just like many of us would do, we just say, yep, sign me up. We don't even know how it works, what it is exactly, and how I can utilize it. Only after a few years in the business that I realized how superannuation actually works. I can do salary sacrifice. Go, wow, what is this? What do I do? And in my head, I thought, yes, great, put some money there. It is invested. When it's grow, I can take some money. No, that wasn't the case because superannuation have a few restrictions. You can only withdraw the fund in the event that you have some financial difficulties or you have reached the age of 60 now. So, well, then in my head, why do I even want to salary sacrifice that? My income wasn't that great before, so there is no reason to do all that tax minimization strategy and all those things related to super. And also, I moved employment quite a bit at that time. Before finance, I was actually in hotels. I like hotel management. I spent most of my life at front office, worked my way up to duty manager, front office manager. And by moving from hotels to hotels, one employer to another, I opened up multiple superannuation funds. Mind you, I didn't know any better back then. So I did what any of us would do in the circumstances that you don't know what you don't know. So I guess this is why the presentation today is to provide information for you about how superannuation works. Please note, this is a general advice only. It is not a personal advice. I haven't taken any consideration about your circumstances, your goals, your needs, and your objectives. So please, if you wish to contact me after this presentation, you will be able to access my website, or there's a QR code at the end of the slide where you can scan it and book a 15-minute chat with me over the phone. Okay. Now, we mentioned before, general advice only. Please, I prepared this presentation without taking any account your objectives, your financial situation, or your needs. make sure you see a financial planner or a financial advisor before you do anything attributed to this presentation today. The agenda for this presentation, we'll be talking about what is super, choosing the right super fund for you, contributions, investment options, the fees associated with super funds, and the insurance, should you have any, through super. So what is superannuation? Superannuation is a system where money is placed in a fund to provide for a person's retirement. Your employer must pay 12% based on the current financial year of your earnings into your super fund. This is called employer super guaranteed. You can also top up your super by making your own contributions. This can be done by making a pre-tax or concessional contributions, or by post-tax, which is non-concessional contributions. What is concessional contributions? So concessional contributions at the moment, it is capped at $30,000 based on this financial year. 2025, 2026, there's a typo there. I do apologize for that. It's 2025, 26 financial year. So what is considered as concessional contributions? It's employer super guaranteed, which is the 12%. So for example, if your income is $50,000, then your super guaranteed is $6,000, which is 12% times $50,000. And the current super guaranteed rate is 12%, which may be different in the future. And another method is salary sacrifice. So this is to sacrifice part of your pre-tax salary to be contributed into super. This is the agreement between yourself and your employer. Just keep in mind though, not every employer offers this type of contributions. I'll give you an example. So this is a case study. It's not related to anyone. I just pull a name on top of my head. Sarah seems an easy name for somebody to remember. So I just pull Sarah here. She's earning $90,000 before tax, which if you put a salary employer super guaranteed, then she'll get 12% of that into super. So the first scenario where there's no salary sacrifice, Sarah is taking home 70,412. How do you get that number? It's basically simple enough, $90,000 minus tax and Medicare, which comes to 19,588. So if you put 90,000 minus 19,588, it will comes to 70,412. So then the total tax that she pays, 19,588, which benefit her 70,412, which is the take-home pay that she's receiving. Now, consider that if she has a salary sacrifice, in this situation, she's salary sacrificing $10,000 into super. So what it means is that her salary that she will receive home is only $80,000 because the $10,000 will go towards her super as salary sacrifice. How does it work? So with $80,000 minus the tax and Medicare, which is a totaling of $16,388 approximately, her total take-home pay would be $63,612. So if she is salary sacrificing $10,000, as you know, super is taxed at 15%, so the 1,500 is taxed. The amount that goes into her super is $8,500. So in this situation, You can see the total tax that she's paying, basically the tax Medicare plus the tax in super equals to 17,888. So from these scenarios, you can see that the amount of tax that she's paying suddenly reduced, while at the same time, the benefit that she's received, which is the take-home pay, plus the amount of the salary sacrifice, comes to $72,112. So you can immediately see the benefits of salary sacrifice in this form. You have to be careful. This is general advice only, because you don't want to hurt your cash flow outside super. Because any money inside super, you won't be able to access that until at least you're 60. So you want to be careful with this strategy. Seek a financial advice, see a financial planner to make sure that this strategy actually appropriate for you. So how does super work? Over the course of your working life, the contribution accumulated are invested by your super fund with the aim of growing them even further. Hopefully, it'll be greater than the cash rate the bank provides for you. To help ensure your superannuation savings are there for you in retirement, the government places restrictions on when and how you can access your super. So when can I access my super? At retirement age. Ideally, you need to wait until you retire, but in general rule, you need to be at least 60 years of age for your super to be tax-free, with some restrictions. I do get a lot of questions. My clients ask me, when can I retire? I don't believe there is any restriction in Australia when you can actually retire. Although, if you need access to your superannuation, you need to be at least the age of 60. So if you accumulated enough wealth in your 40s and you think, I'm happy with what I have, and then you want to retire, by all means, but still, you are not able to access your super yet. So options after retirement. Once you have retired, you can then have a regular income stream. To make your retirement more comfortable, you can take out a lump sum, but you have to be careful because you will be retiring on this fund. You want to make sure that the amount that accumulated will be enough to cover for you to a lifetime. As a financial advisor, we have strategies in place to make sure that is the case and it will happen for you, and your money and your capital will last you a lifetime. That's part of the planning. You might be able to combine regular income stream with centering age pension. Not everybody will be eligible for centering age pension. It will be depending on your assets and income. Some assets, if you go above the threshold, then you won't be able to access the age pension. And if your assets within the threshold, then you will have to apply an income test as well to see if it's actually eligible for you. If yes, then they will look at which one is the lowest number, asset test or the income test. If whichever test that provides you with the less income, that's what would you get. That's what you would get. Considerations. When accessing your super, it's important to consider your long-term financial needs and plan accordingly. That's why spending plan is very important at retirement. You need to know your baseline. You need to know how much money will you be spending month to month, day to day, week to week, years on years, because then you can identify where your baseline is and how much money do you need and whether you need to increase or decrease in any particular year. Choosing a superannuation fund. you need to find out the track record and the fees associated with the funds. Where can you find it? You can find it with the PDS or product disclosure statements of any fund that you have, or you can look at from your annual statements that you get from your super fund. On that report, it will show you the fees that they charge you on that. Investment options and insurance. Does the fund offer a range of investment options for you? For most cases, it is enough for majority of people. In some cases, you may want more complex alternatives. Then you find out whether the super fund offers default insurance, such as life insurance, total permanent disability, and or income protection. And also the availability of advice to help you make decisions about your super. Think about it. If you ring your superannuation at the moment, would you be placed on hold? Would somebody on the other line answer you? Would that be those generated ones that will tell you to press number 1, 2, 3, 4, and then it will divert you to a different link about 3 or 4 times before you actually reach somebody to talk in person? And sometimes, how long does it take for you to reach that person? And also, after you provide inquiry of what you want, how long does it take for someone to actually provide that information for you or fix that issue for you? That is something you need to consider as well. For majority of people, I've done it myself, is that I didn't have a full understanding about super at that time, so I just let it be. I know that I signed up for superannuation fund and I just let it be. And I don't know anything about that. I don't have any understanding about that. And so I don't see any need to call. But now I'm hoping that you have a better understanding about your super fund. You'll be able to make a call. You may be able to find out. You may be able to raise a few questions for yourself. And hopefully you get the answer that you're looking for. So which investment option is right for you? Super funds invest your money to grow your nest egg over your working life. Most people don't even know about their options, and they are generally placed on my super option. It's done that by default. So if you apply for a superannuation fund, you didn't indicate of which particular investment options you want to go with, it will automatically go to my super options. In most cases, it will be balanced profile. So most common investment options are as follows. It is not limited to this, but for majority of cases, it will be growth, balance, conservative, cash. Okay, the difference is basically the level of risk reward that you'll receive and certain strategies that potentially more focus on growth and some strategies that is more focused on income. So for instance, in growth option, higher risk option with potential for higher returns over the long term. So what it means is that in the short term, you'll see a lot of fluctuations in the market. So there would be a lot of volatility from year to year. But the aim is potentially beat CPI, negate the inflation risk, and provide you with a better capital growth. In the balance options, it is a moderate risk with a mix of growth and defensive assets. Conservative, small lower risk options with more stable but potentially lower returns. Cash is the lowest risk option with focus on capital preservation and providing steady income. But here, the risk is not anything to do with the market, but you're risking yourself through inflation. Because as you know, as years go by, your cash diminishes in value. I'll give you an example. What you may potentially be able to afford $50 a couple of years back, now you need to spend $80 for the same thing. I guess we experienced those during COVID. A lot of people talk about inflation. A lot of people talk about how it is hard to just buy groceries because all the prices goes through the roof. Superfund fees. To keep in mind, a 1% difference in fees now could be a 20% difference in 30 years' time. So just because it is an acceptable rate of fees at the moment, it doesn't mean that it will be beneficial for you in the long run. Yes, you need to pick a fund that charges lower fees, but I think it is more towards understanding what you need, and the fees should reflect on those needs. If you're just starting out in employment, you open up your superannuation fund, you started at a very low balance. Is it necessary for you to go into an expensive platform that provides you with the X, Y, Z options, highly complex? Probably not. In this case, you don't really need to have those complex platforms because you're not going to need it at the moment. Maybe later down the track in the future. So when you're starting out, lower fees is generally better. Typical fees include ongoing administration fees, you have membership fees, there's investment management fees, there is advisor service fees. If you seek a financial advice, then the financial advisor may manage your portfolio, and for that, there may be a advisor services fee involved. And also, if you have insurance within your super, then there will be an insurance premium as well. So insurance in super, you probably have some already, but the important thing is that enough cover for you? Is that relevant for you? Just because it is provided for you, it doesn't mean that it provide covers for your need. So it is very important to have insurance that protects you, and it is based on what you need. So most common types of insurance in superannuation are life insurance. It provides a lump sum for your loved ones in the unfortunate event of your death. Hang on a second, my camera seems to be playing up with me, so I just need to zoom out a little bit so you can see my full face. The next insurance will be total permanent disability. It provides a lump sum should you are injured and unable to work. There are certain conditions to actually claim this type of insurance. It's not an easy one. And the last bit is income protection. Provide a replacement income up to 70% if an injury or illness resulted in you not working for a period of time. So general cover would be you have a waiting period of 90 days and a benefit period of 2 years or 5 years. Different funds have different benefit periods or waiting periods as a default cover, and some industry funds don't even offer income protection. So it is something that you have to consider as well, especially when you start earning higher income. Do I have the right level of cover? Well, that really depends. You'll need to seek a financial planner to find out the right level of cover for you. You have to think about, let's say, if you have a mortgage of 800,000, what do you think is the right level of cover for you? What's the outstanding balance of that mortgage? You have a certain lifestyle. In the event that you passed away, would your partner be able to survive the repayments of this mortgage without you? Would your family be in a difficult situation? How about the education costs for your children in the event that you passed away? Would your kids be able to go to the same private school if it's only on one income? When was the last time you checked your life insurance in your super? Do you know the life insurance level of cover in super reduces as you get older? So perhaps it is time for you to speak to a financial advisor. Well, the next steps for you, find out your goals, your objectives, your needs. What would be an ideal outcome for you? We can talk about wealth protection, we can talk about wealth creation, we can talk about retirement planning, and we can also talk about aged care, should you wish to. Well, make sure you follow me for more tips and information, and use the QR code to access my calendar and book a 15-minute phone chat with me. I'm happy to explore any options or any difficulties that you may come across in your financial circumstances, and perhaps I may be able to help you with that. Thank you very much for listening. Felix Budiman from Prime Wealth Advice. You have a good day.